Hello everybody, in this video we are going to discuss about CA Foundation Introduction to Partnership Accounts. Why we need to discuss about these topics, what are the main core areas will be discussed here. So firstly, why we need partnership form. If individual single person may start business, may continue his business, but after sometimes it is not possible to take positions of both managerial demanding present days that financial and non-financial, so they will consult with two or more persons. They will decide to pool their finance accounts of their amounts or financials or non-financial resources. Now, as per section 4 of partnership, what is mean by partnership? Partnership means is a relationship between two persons who have agreed to share the profits of a business carried by all or any of them. So here the business will be started between two or more persons, and they will share the profits, and the business will be carried out by one person or all of the partners. What are the features? For example, if we have A, B, C agree to run one clothing business and they share their profits equally, if there is any mutual agreement on the basis of their partnership there. What are the key features for existence of this partnership? So key features will be agreement between the partners will be required, mutual agency will be required, sharing of profit and loss, unlimited liability, business carried by all or some person will carry. This is the definitions cut up. Now, existence of agreement means, as per section 5 of Indian Partnership Act 1932, the relationship of partnership arises from contact between parties and not from status, as it happened in case of HUF. So normally in case of HUF, simply the persons whoever existing in that family by birth, they will get the right of that person. But here we should require some contact. A contact may be formal contact or written contact. The agreement is not necessarily required to be writing. So for example, A and B is there, and they are verbally agreed to start a bakery, and they both invest money and share profits. So the overall agreement also is valid for this types. Now, what is meant by business? Business means what they want to carry on a business, which means any trade or occupation or profession, etc, etc. For example, A, B, C, they want to start a business of IT services. This constitutes a partnership as it involves continuous activity aimed at profit, earning profits. So business means simply they have any trade or occupation, they have one aim to earn the profit, they have continuity activity, then it is known as business. Next, sharing of profit. Here partners must agree to share the profits of the business, or losses generally shared in the same ratio unless agreed otherwise. Normally they will decide profits, and also losses will be shared based on this agreement. If there is no agreement, there is no not required to maintain. Normally the presence of sharing lot is not necessary, because every person want to start business to make profits, not for losses. Next, mutual agency means what? Each partner act as both an agent and principal. Means here the relationship between the partners will have partner and principal and agent relationship. So any partner can bind the firm with their actions, provided they act within the scope of their business. For example, if partner A enters into a contract with a supplier on behalf of the firm, so then all partners B and C also will need to bind for that contract. That is mutual agency. Next, minor partner here, as per Indian Partnership Act, minor cannot be a partner in any forms, so normally it will be not allowed. But however, with the consent of all partners, so here we need to take the consent of all partners, minor can be admitted to benefit of in existing partnership. So for example, we have partnership from A, B, C. Now we want to join one partner D who is having age of 16 years age. So now whenever we want to admit, we need to see for the benefit of that partner we can admit, and here the A, B, C will be there, and D is entitled to share the profits only but not liable for any losses. Now what is the, how many number of partners, minimum partners how many, maximum partners how many. Minimum as per section 464 of minimum partners will be 2. As per section 464 of companies act, no association or partnership consisting of more than 100 members of persons as may be prescribed shall in the forms for the purpose of carrying on any business. It is as per partnership companies act. Rule 10 of Companies Incorporation Rules 2014 specifies limit 50. So for partnership it will be 50. Now we will start with limited liability partnership. LLP Act 2008 here to combine the benefits of company and combine the remove the disadvantages of partnership. We will show this LLP offering limited liability to its partners while maintaining flexible internal structure. For example, here we will take one example. X and Y wanted to start business but were concerned about unlimited liability. So they want to start one business, X and Y, but they will concerned about the unlimited liability. So they choose to form an LLP providing them with limited liability while allowing flexibility in managing business. So they can start the LLP, then they can have limited liability and they can manage. Here what is the key advantages and disadvantages for the LLP? So advantages will be mainly they have limited liability and there is no limit on the number of partners, and flexible management structure. They have flexible management structure and they have complaints will be less complaints than company. So company need to follow many but LLP will not be required to follow many. And what are the disadvantages? Disadvantages will be LLP cannot raise funds from the public. So LLP is not allowed to raise funds from the public, and less recognition globally compared to companies. So companies have more recognitions. So they have public disclosure of financial statement, no option for equity investment, extensive penal provision for non-compliance. Now what is mean by LLP? For example, here for disadvantages, advantage, an IT consulting firm formed as an LLP enjoying the benefits of limited liability, but it faces challenges when trying to secure insignificant funding due to its LLP structure. Now LLP definitions. Here LLP is a body corporate formed and incorporated under the LLP Act. So it will be formed and incorporated as per LLP Act 2008 with legal entity separate from its partner, perpetual succession, and they have limited liability. So it will be different from the partners, and they have perpetual succession and they have limited liability. Now here for example, Jed Consulting LLP is formed by three partners. The LLP itself is a separate legal entity and distinct from the individual partners. So they do not compare with that persons. So it have their individual formness. Next, what is mean by small limited liability partnership? LLP with small LLP to an act that meet the some specified criteria related to its capital contribution and related to its turnover, then it will be treated as a small limited liability partnership. Now what are the key features for this small limited liability? They have limited liability like as traditional LLP. In small LLP also the liability of each partner is limited to their contribution to the partnership. This means the partners are not personally responsible for the debts of the business beyond what they be invested. And what is the size criteria here, threshold criteria? capital contribution. The total contribution of partners should not exceed certain criteria. For India, it has 25 lakhs, so should not exceed the 25 lakhs total contribution of partners or turnover. The annual turnover should not exceed the specific limits. So turnover will be 40 lakhs, and the amounts here, the 25 lakhs will be the does not exceed. But if it want to exceed, it want to increase that amount, then they may increase up to 5 crores, and for turnover it will be 50 crores they may include. Now they, for small LLPs, they have compliance relaxation. Small LLP might enjoy certain relaxations or exemptions in terms of compliance requirements, such as fewer disclosures, reduction audit obligations, or simplified filing procedures. For example, ABC Consulting LLP is there, and they have register has small LLP, and they have partners, three partners, one Rahul, Priya, Ankit. Now capital contribution of each partner is Rahul was 10 lakhs, Priya was 5 lakhs, Ankit was 5 lakhs. So then total capital will become 20 lakhs. Annual turnover it will be 30 lakhs. So whenever the capital contribution is less than 25 lakhs and the total turnover specified limit less than 40 lakhs, they may register as small LLP. Now what are the features for this ABC Consulting Company? Limited liability. So each partner liability is limited to their contributions. So for Rahul 10 lakhs, Priya 5 lakhs, Ankit 5 lakhs, and not beyond. Next, compliance requirement. Since the capital contribution is 20 lakhs, annual turnover is 30 lakhs, which is having below threshold limit, that is 25 lakhs and 40 lakhs. Now ABC Consultant LLP qualifies as small LLP. Has a small LLP, ABC Consultant LLP might have simplified compliance requirement, such as fewer audit obligations or easier filing process. Next, accounting in partnership accounts. Now profit sharing. For example, assume that LLP makes profit, so they invested 20 lakhs, they got profit of 15 lakhs. If they have profit sharing ratio is equal, then Rahul will get 5, Priya will get 5, Ankit will get 5. Now distribution of profits. The profits can be distributed among the partners, whatever the partners will be based on their agreements, and it will be recorded in the books accordingly. Here this structure is beneficial for small businesses or professions like consultants, small firms who want to benefit of limited liability while also keeping their compliance burden lighter. Now what is the nature of LLP? Now nature of LLP means here LLP has separate legal entity, per identity, perpetual succession, and limited liability for partners. Like same as unlike traditional partnership, LLP can continue to their existence irrespective of changes in partners. Example, even if one partner in an LLP retires, the LLP continue to exist and operate without needing to dissolve or a reconstitution of firms. But if it is a partnership, one person is retired, then the firm need to reconstitute or dissolve. Now how many minimum number of partners in case of LLP? As per LLP Act requires minimum 2 partners to LLP, but there is no maximum. So minimum we have 2, maximum there is no limit. For example, A and B decide to start an LLP. They fulfill legal requirement of having at least 2 partners, so they may start the business. In a partnership, certain individuals or some entities are legally or practically incapable of becoming a partner due to some restrictions imposed by the partners. Who are the partners? Some persons like minor. Minor means who is under the age of 18 in most jurisdictions is legally incapable of entering into contract including partnership agreement. But however, a minor can be admitted to benefit of an existing partnership but cannot become full-fledged partners. Example, if partnership from XYZ traders want to admit new partner, they cannot admit 16 years old as a partner. However, the minor can share in profits but cannot participate in management or be held liable for the firm's losses. So he is not liable for firm's losses. He is not eligible to manage the partnership firm. Next, another person of unsound mind, which is individual who is mentally incapacitated or declared of unsound by the competent authority cannot enter into contact and therefore cannot become partner. For example, John he is diagnosed with severe mental illness and declared unsound mind by a court, so he cannot be a partner in law firm. Next, insolvent person, a person who has been declared insolvent or he became bankrupt cannot enter into contact including forming or joining a partnership. For example, Mr. A is there declared bankrupt by the court. He cannot join or continue as partner in ABC Enterprise as he no longer has the legal capacity to participate in partnership. He is not entered into this person, so he insolvent person is not eligible. So minor, unsound mind, insolvent persons. Next, corporations or companies with some restrictions. So corporations can generally be partner in partnership firm. However, certain companies may have restrictions in their memorandum or articles of associations that prevent them from becoming partners in a partnership firm. For example, a company named Tech Innovators Private Limited has clause in its articles of association that prohibits it from entering into any partnership. Therefore, Tech Innovators Private Limited cannot legally become a partner in another business. So here what we are telling, on company is there and in that company it have articles and that article they have prohibiting to entering into any partnership, then that company is not legally become partner in another business. Next, some alien and foreign nationals. Foreign nationals or allies may face restrictions in becoming partners, particularly if they are from a country with which the host country has political tensions or restrictions on business dealings. This type of country is also not eligible to become partners. For example, Iran citizens might be restricted from forming or joining a partnership in certain countries due to some international sanctions or local laws. Some persons disqualified by law. Individual disqualified by any specific law or court order. For example, disqualified director cannot become partners. Example, if a person disqualified from being a director under Companies Act due to some fraudulent act, they are also like to be disqualified from becoming a partner in partnership firm. Next, designated partner. Here, who is mean by designated partner? Designated partner means as per section 7 of LLP Act, designated partner are responsible for ensuring compliance with statutory requirements and managing the day-to-day operations of the LLP. So now at least two designated partners are required and they must be individuals. So at least two will be required and there must be individuals. For example, in Chet Consulting LLP, here A and B are designated partner responsible for filing annual returns and ensuring compliance with legal obligations. Now, what is the liability for these designated partners? So liability for these designated partner are responsible for legal and regulatory compliance of LLP and can be liable for any non-compliance. So what is the liability? Designated partner is responsible for legal and regulatory requirement and can be liable for any non-compliance. If any non-compliance is there, he is responsible. For example, if Jed Consulting LLP fails to file its annual return, the designated partner A and B can be held liable and face penalty. Now, what is the limitation of liability of an LLP and its partners? Limitations of liability and its partners. Partnership liability is an LLP is limited to their agreed contribution to the LLP. So whatever they are agreed to contribute, that much only they have liability, except in case of fraud or wrongful act. For example, if Z is a consulting LLP incurs some debt of 10 lakh and each partner contributes 2 lakhs, their liability is limited to this amount, provided there is no fraud is involved. Next, what financial disclosures and returns? LLP are required to maintain financial records, prepare annual accounts of and final annual returns. So they need to prepare records, financial statements, annual returns with the registrar of LLP. For example, every year Jet Consulting LLP files its financial statement and annual returns with the registrar to comply with statutory requirement. Next, distinction between the ordinary partner form of partnership firm and LLP Act. Now, this ordinary partnership firm means normal partnership firm means partners have unlimited liability. The firm has no separate legal identity and there is no perpetual succession. But LLP have limited liability, separate legal identity, and they will enjoy for perpetual succession. For example, in partnership firm, if the firm incurs losses, partners personally assets are at risk. So normal partnership firm, the partners personal asset also in risk. In an LLP, partners liability is limited to their contributions. Now, what are the major differences? Now liability will be unlimited for ordinary partnership firm. LLP, it has limited legal identity. There is no separate legal identity for partnership firm, and LLP have separate legal entity. Perpetual succession is not there from partnership, and it have LLP partnership. And compliance will be less compliance for partnership, and LLP have some more compliance. Now, what is the main classes in a partnership deed? A partnership deed typically includes classes related to the name of the firm, nature of the business, capital contribution, profit sharing ratio, duties and obligations of partner, provisions of dissolution. These all items, these all classes will be required to be noted in the partnership deed. For example, a partnership deed between A, B, C. Yes, they need to include that specifically. They mention profit sharing ratio will be 3 is to 2 is to 1. Then outline the procedure for admitting a new partner. What are the main classes will be required? So what is the name of the firm? Name of the firm and name and address of the partners, nature of the business, capital contributions, profit sharing, duration of partnership, rights and duties of partners, and methods of valuation of goodwill, provisions for dissolution. These are all the main partners. Now, goodwill. Here we are talking about the goodwill also. So, how will be there for goodwill treatment? Goodwill treatment in partnership. Goodwill means normally it is intangible asset representing the firm's reputation. It is often adjusted when partners are admitted, retired, or firm is dissolved. Now, if goodwill is valued at 30,000, the new partner is admitted. D might pay for his share of goodwill when he is admitting the partnership firms. Now, when there is rules in absence of partnership, so the partners are not written any agreement, so there is no partnership deed. What is the consequences? Then, in absence of partnership deed, the provisions of Indian Partnership Act 1932 applies, then such as equal profit sharing ratio will be there, and no interest on capital will be allowed, no salary to partners will be allowed, no interest on drawings will be allowed, but interest on capital will be allowed at the rate of 6% per annum is to be allowed on partners loan to the firm. For example, if ABC they started a partnership without a deed, they must share profits equally regardless of their capital contribution or involvement in the business. So, if they do not have any partnership deed, they need to maintain equally profit ratio. Profit sharing ratio, the ratio of which partners share profit and loss of the firm. For example, if partnership profit sharing ratio is there 3 is to 2 is to 1, ABC and profit for the year is 60,000, then we'll go with A. For A will get 30, B will get 20, C will get 30 10. If there is option in of deed, all will get 20 each. Now what are the powers of this partnership partners? So powers of partners, partners have authority to manage the firm's business, enter into contact and bind the firm in transaction with the scope of business. So partners have authority to manage the firm's business, entering into contact bind the firm in transaction within the scope of business. So if partner A signs lease agreement for the firm office space, all partners are bound by this agreement. This is main. So powers will be buying and selling, receiving payments on behalf of, drawing checks, accepting and submitting here. Now how they maintain the accounts? So accounts maintained, partnership firm maintain various accounts such as capital account, current account, revaluation account to track each partner's capital contribution account, withdrawal account, share of profit account. These all accounts will be maintained. And example here, a partnership firm maintains separate capital account for each partner reflecting their capital contribution, drawing and share of profits. So what now we introduce the name of revaluation of assets and liability. What is mean by this revaluation of assets and liability? When new partner is admitted, or partner is retired, the assets and liabilities of firm may be revalued, may need to revalued. Example, if the land was earlier recorded at 50,000 but its current market value is 70,000, so earlier it will be 50, now current market value is 70. A revaluation profit of 20,000 will be distributed among existing partners. Next, reconstitution means what? Reconstitution means admission, retirement, and death of partners was happen. Now, different scenarios like admission, retirement, death of partners will impact the partnership. Then they will reconstitute of the partnership. Now, another profit, another statement in partnership accounts. One is normally we will prepare profit and loss account, but here additionally we will prepare profit and loss appropriation account. What is this profit and loss account? What is this profit and loss appropriation account? Profit and loss account means it to show the overall profit or loss of the firm after all expenses. Next, profit and loss appropriation account means it to show the distribution of net profit among partners after appropriation like interest and capital, salary to partners. It will be taken from after appropriation means after the distribution of among partners. For example, if the firm has net profit of 1 lakh, the profit and loss appropriation accounts will show how this profit is distributed among partners after deducting interest and capital and salary. So in profit and loss account appropriation, what we can see, if we have 1 lakh of net profit, we need to see after considering, after deducting the interest and capital and salaries. Normally in profit and loss appropriation accounts versus profit and loss account. So in profit and loss account we need to show net profits or loss including all expenses. In profit and loss appropriation account we need to show distribution of net profits. So we have net profit from net profit and loss account, we need to distribute that net profit which includes interest and capital, salaries, etc. Now after the profit and loss account we have capital accounts. So different types of capital accounts. So capital account will have in two types. One is fixed versus fluctuating capital. Now partners can maintain either a fixed capital or fluctuating capital. For example, in a fixed capital method, each partner capital remains constant, while the current account reflects they have drawings interest and capital. It will show in current account. For example, fixed capital method means what? Fixed capital method means the capital of partners remains constant. The capital of the partners remains constant, and any other transactions are recorded in the current account. So normally they maintain capital account at constant. It will be fixed capital. Any other transactions will be shown in current accounts. That is fixed capital method. So in fixed capital account, they will maintain two accounts. One is capital account remain constant, and another one is current account. Now fluctuating capital method. Fluctuating capital method means the capital of partner fluctuates with each transactions, including profits, drawing interest, etc. In a firm following the fixed capital method, A's capital remains at 1 lakh, while drawings and profit shares are recorded in separate capital accounts. So if you go with the fixed capital method, the capital will be same and they will maintain another account, current account. In fluctuating method, they will adjust for all items in same. So every year there will be changing of capital. So fixed capital method means capital remains same, separate current account will be maintained to record drawings, interest, salary, etc. In fluctuating capital method, capital will fluctuate with transactions. There is no separate current account will be maintained. Single capital account, that is record all transactions like including drawings, interest, salary, etc. etc. This is fixed asset. And next, interest and capital. Interest and capital means is the return given to partners for their capital contribution to the firm. So whatever the capital they contributed to the benefit of partnership firm, so they need to get returns for that investment. It is as usually specified in the partnership deed. For example, if partner A has contributed 1 lakh to the firm and partnership deed specifies an interest rate of 10%, A will receive 1 lakh into 10% means 10,000 he will receive only when there is there in agreement of the percentage interest and capital, then only it will be allowable. Next, interest on drawings. Interest on drawings means here we have interest on drawings is charged to partners when they withdraw funds from the firm. So when they are received the fund from the firm, it discourages excessive withdrawals and compensates the firm from the loss of capital. So here it will discourage the excessive withdrawals. So some person is withdrawing more capital, it will affect the business. So to discourage that excessive withdrawals, they need to compensate, they need to pay some interest. If partner B withdraws 20,000 during the year, the interest rate of drawings is 5%. B will charge 1,000 as interest on drawings. And another one concept, guarantee of minimum profits. Guarantee of minimum profit means what? Here sometimes one or more partners are guaranteed a minimum amount of profit regardless of actual profit earned by the firm. If firm profits are insufficient, other partners will bear the shortfall. For example, if partner C is guaranteed a minimum profit of 50,000, the firm's profit is only 40,000, then other partners must compensate C for the shortfall. That is guaranteed profit. Next, capital ratio. Here capital ratio means the capital ratio refers to the ratio in which partner have invested in the firm. It often determines the profit sharing ratio unless stated otherwise in the partnership deed. For example, if A, B, C contributed 50,000, 30,000, 20,000 respectively, their capital ratio will be 5, 3, 2, and they might share profits in this ratio. So here the capital ratio means if they how much they are invested, the same if often determine the profit sharing ratio unless stated otherwise in the partnership deed. So they may go with the capital ratio.